right, everyone, welcome back. Money Show is pleased to welcome Brooke Thackray. He became a research analyst with Horizons ETFs Management Canada in 2009 and joined the team responsible for the management of the Horizons Seasonal Rotation ETF. He has over 15 years of investment-related experience and has written and published several books, including the annual Thackray's Investor's Guide series. Previously, Mr. Thackray served as an investment advisor at major brokerage firms, including TD Waterhouse and RBC Investments. He has an MBA from York University and holds the Canadian Investment Manager designation. Brooke, thank you so much for being here. It's all yours, sir.
Well, thank you very much. So today we're going to talk about seasonal investing, but we're also going to talk about what's happening with the election. It's kind of hard to figure out, to make sense of what's happening, but we can take a look at seasonal trends of what's taken place in the past to look for indications of what might come up as well. So this presentation really has been designed around the election, and we'll also take a look at different sector opportunities at this time of the year at the same time. First of all, I have also authored 14 investment books as well. I'm actually working on the 2021 investment book that's actually being submitted for printing right now. And I also put out a monthly newsletter and appear on BNN on a regular basis. And if you're looking to follow along with seasonal investment analysis and find out what's going on in the markets from that perspective, you can sign up for my newsletter, alphamountain.com. There's a Horizons weekly update that I also put out as well, or the company puts out. Or you can also take a look at the book as well that I produce. So I'm going to go quickly over what is seasonal investing. I really want to move into the election stuff, so I'm not going to talk a lot about really get into the weeds about this, but it's important that we do cover it. First of all, seasonal investing is investing at the time of year where it has typically done well, investing in a sector of the market that tends to outperform a broad market, such as the S&P 500, at a certain time of the year. So you're looking for trends with a causational factor that tends to take place. And that's exactly what we're going to be doing today. And so there can be different influences of why these trends exist, whether it's earnings season or supply-demand imbalances or specific announcements that tend to take place as well at certain times. But there's some sort of causational factor. So seasonal investing really is behavioral investing. So we call it seasonal, but it's really about investor behavior around specific events that actually drives the trends in the marketplace. And it applies to broad markets such as the S&P 500, the TSX Composite, sectors of the market, commodities as well, bonds, and also currency. So it's not just one sector. So you can actually take a diversified approach to this to help reduce risk in your portfolio by going across different asset classes with this. The big broad picture from the stock market is that in the period from October to May, or late October to early May, which we're in now, tends to be the better 6 months of the year. And so what you want to do is you really want to be invested in core positions in the marketplace, the broad market positions such as the S&P 500 or the TSX Composite. Go into different sectors of the market as they arise, whether it's the technology sector, the industrial sector, whatever it is. And when those trades finish off, you go back into the broad market. Now, in the other 6 months of the year from May to October, which tend to be the weaker time for the markets. There's still lots of sector opportunities, but you want to go back and forth. The core position is cash, but as the sector opportunities come up like gold, utilities, consumer staples, you rotate into those sectors and then go back as well. So it's really a very active approach in trying to mitigate risk in the portfolio. So now that we have that out of the way, let's take a look and jump right in by taking a look at the average performance of the stock market in an election year. So we're in the election year right now, and then we want to take a look as well at the average performance of the stock market after the election and into the end of the year. And also as well, we're going to take a look at the performance of the stock market in the following year compared to the election year. So in the election year, what you tend to find is that the stock market tends to dip down starting on average, this is from 1952 to 2016. And you can go back and use the data and go back to early 1900s, you find a very similar trend as well. You see here that the market tends to dip down coming into the election. That's exactly what's taken place this year. On average, you tend to find the bottom of the market before the election. So usually sometime in late October. I mean, so far it would have been last week. Anything can happen, of course, but so late October as well. And you find that the stock market overall, on average, tends to perform well from late October into the end of the year after the election. So you see that dip that's happened here, and then also too, you see the rise towards the end of the year on average. What I want to do is I want to go through the different decades on this really quickly and show you the overall trend, because you don't want just averages to skew the results. You want to actually take a look at the actual individual years and to get a feel for what's driving this as well. But if we take a look at the performance from October 26th until December the 31st, from 1952 all the way down to 2016, and so that period for the end, towards the end of the year, there's been a couple of losses, but really it doesn't matter if it's Democrat or Republican. You see a lot of, oh, if the Democrats win or the Republicans win, and it's a small sample size. You have to be a little bit careful on that too. But you tend to find a positive performance for both the Democrat and also to the Republicans if they get power or to win the election towards the end of the year. I mean, this election has been kind of crazy. We've seen that dip coming down towards the end of October. Then we saw the blue wave response in the marketplace. The market ran up, and when Trump looked like to be a winner, you saw the market go up higher, and then back to Biden, and the market's still going up. So a lot of people are very confused about what's happening here. And a lot of times what's happening is it's not just about who's going to get in power, but also there's just a lot of anxiety in the marketplace. And once the election occurs, the market tends to run up as well. But let's get into that. Let's go back and take a look at the 1950s here and into the 60s as well. This is the election year, okay, from October 26th to December 31st. You can see here that overall, on average, you tend to see that you see this positive increase for the stock market going up. Now, you saw a couple of nominal, losses here as well in 1964, 1968. But in this case, you saw most of the times you saw the stock market going up. If we look at the 70s and 80s as well, you can see here the overall trend from late October. Now, in this case here in 1980, this is just at the top. Interest rates were rising. But we saw this really spike, but we still saw after, even though it was a volatile market, we still saw that positive performance towards the end of the year as well. And once again, you can see here positive performances taking place, and there's a nominal negative in 1988 overall. But the other years really were positive, independent of whether it was positive or negative leading into the actual election itself. And this is actually looking at the 2000s, the 1990s and the 2000s. And so this line here represents, as I said before, the October 25th, so late October. 2008, the purple line, we all remember the great financial crisis. The market dropped down into the election. There was an election here. And you can see here that in this case here with 2008, is actually, we really found a bottom after the election in all cases. The other we want to take a look at is 2000. That was after the tech wreck, right? So it just seems these elections come up about this time actually. And so this was actually negative for that. But you can see here the other cases you basically can see here that we've seen either nominal or stronger gains for the market from October into the end of the year. And here we see the brown line here is currently 2020. This graph was done a couple of weeks ago. You can see here that we saw that top in September. We actually saw that market pull back into here. Now, we could see some volatility here, but if we take a look at what's happened over recent times, once that anxiety is removed, and there's a lot of positivity about what can happen, then we can see the market actually perhaps move up higher from here. I also want to take a look at what happens in the following year. So really, how's the market behave? And there's a little bit of concern here that might be developing as well that you have to pay attention to. So, and what I've done here is I've plotted the average inauguration here. Now, the inauguration days has changed over time. There's different, but on average in the last few decades, you can see here it's really around January 20th. And I've also plotted out here the honeymoon period on a seasonal basis. So a honeymoon period's at 100 days, once you get into power. Now, inauguration, even if the incumbent wins, there's still an inauguration, but you wouldn't get the same honeymoon period as you would for a new president coming in. But there tends to be this period where there's a little bit of a let's give the president some room here to show us some policies and some vision about what he's going to do or she's going to do. So you can see here, what's interesting is up until the inauguration in the new year, the market tends to be a little bit flat on average. And even there, we tend to see this flat performance really until towards the end of that honeymoon period, and we see the stock market rally. We see this flat period really, which is typically part of that 6-month cycle. Usually the market tends to be weaker in the summer months. And then you see the stock market rise in the election years, the year after elections from 1953 to 2017. But so I want to go through and take a look at the performance of the 50s and 60s as well, and look at biannual decades. We can see here overall, we saw that this one time in 1961, we saw a really strong performance here. We saw that strong performance coming into May as well, strong performance coming into May. But in this case here, we saw 2 negative nominal losses and also a bigger loss. So we're starting to see a few losses that can occur into May. That's really being skewed by a couple of bigger performances overall. And you can see here that there were, by the end of the year, there were 3 years that were actually losses at the same time. If we take a look at the 1970s and 1980s, you can see here, once again, in this case, by the end of that honeymoon period, so the beginning of May, 2 years were positive, and also as well, there were 3 years that were negative. So it's really mixed. The tendency for the market to rally from October in election years towards the end of the year is stronger than to actually perform really well in the next year as well. If we take a look at the current 1990s and also the 2000s, which we're currently in right now, you can see here that if we take a look here, we see this mixed up until the inauguration, and really on May, it's once again, this is really mixed. It's, some of the years are up, some of the years are down on average. In this case here, but by the end, most of the time, other than 2001, which is from the Great Financial Crisis, you still see positive performance. This is what we've seen, positive performance. But most of that most of the gain tends to occur around the October time period as well. So, overall, when we're looking at this scenario in the year after elections, you tend to find the markets initially looking for traction at the beginning of the year to see what's going to take place to play out. The first part of the year coming into May, a little bit of a rise, a flat period, and towards the end of the year, the market actually can do quite well. I want to take a look at the Canadian markets and compare them as well. In this case, we're going back to 1980 as far as a sample size goes to 2016. So this is in the election years and what takes place. So the blue line represents the TSX composite index. You can see here that the TSX initially tends to underperform the US market after the election. And by the end of the year, they tend to be, for the full year together now, we've seen strong performance from the technology sector, which has really, changed things up in what's taken place here. But if we take a look at this is telling us right here is that on average, the US market tends to be the better broad market overall from late October into the beginning of the year in the election year. And if we take a look at the following year, so the year after the election actually takes place, so 1981 to 2017, so this, in this case, for us, this is the 2021. You can see here that it's similar trends to what we looked at before when we just looked at the S&P 500. Fairly flat in the beginning, a little bit of a rise that takes place here. And you can see here we've seen a little bit more of an uptick that's taken place coming into here, particularly around the Q2 earnings season. Fairly flat here and stronger performance. Now, I want to point out that in this case, the black line represents the S&P 500. And so what we're seeing here is towards the end of the year, which is seasonally what usually takes place, is the US market outperforms the Canadian market as well. Now, in this particular election, there's a lot of investors talking about, oh, if it's Biden that gets in, the sector is going to do well. If it's Trump that gets in, we've seen some really rotating back and forth. It's a reflation trade, and the market really is trying to find its way right here. Today we've seen very positive rally in the market where everybody's just pile into the market, let's pile into tech stocks, which is partly driven by falling yields, which helps the tech stocks overall. But overall, we are looking at typically stronger performance for the U.S. Stock market on average. Now, it's hard to say what can happen in this particular election in the U.S. With this probability that it could be contested or recounting of ballots and all sorts of stuff. So we might see some volatility coming up as well. I want to take a look at a couple of seasonal trades that are at this time of year or coming up shortly as well. And, they might be driven by different factors. And gold, I want to take a look at because, if we take a look at what gold gets driven by, it's largely being driven by the interest rates. And so when, we see real yields going low, then that actually helps gold. And so that provides a better opportunity for gold. And so, as far as tracking that goes, or even the US dollar as well, can provide some indications. But I want to take a look at the seasonal trend and how it applies and take a look at how it's done in the past as well. So gold has two seasonal periods. One's coming up very shortly. Yes, Christmas is just around the corner. December 27th. I know that sounds crazy, to January 26th. This seasonal period is driven by larger consumer purchases of gold by the Chinese coming into the Chinese New Year. And with seasonal investing, it's important to realize that you really want to go into a sector before the actual event takes place. And once everybody else is getting into the event or into the markets or the sectors around a specific event, that's the time to leave. So you're really, once again, you're playing on that behavior to be in before everybody else gets in. When everybody else gets in, you get out. And that's why this is actually before the Chinese New Year for it taking place. And the next seasonal period is one that's just passed from July 12th until October the 9th. As well for gold, and it was positive in that time period. And this is really driven by the actual gold tends to have a greater demand in the fourth quarter as well, which drives that particular seasonal period. But I want to focus on this particular seasonal period here from late December to late January. And if gold's running, it's I know that's a short seasonal trade, but you can actually say, okay, maybe I put a stop underneath this as far as that goes. If we take a look at this graph over here to the right, you can see here that we have this little bit of a flat period in between October and coming into January, and then we can see here this uptick that tends to take place, and this is relative to the S&P 500, and that's really what you're after. I mean, gold can do well at different times of the year, but in this case here, we tend to find that if we look at the bottom graph here, gold can perform particularly well. And that's really what you're trying to capture as well. And so in this seasonal period from 1984 to 2018, the gold has performed from December 27th to January 26th. It's an average gain of 2.3% and being positive 53% of the time. Now, even in a seasonal period, gold can have big dispersions, be positive and negative as well, but it has a tendency at this time to perform well. Now, let's go back and take a look. Over the last 7 years on this particular graph, you can see here that gold has been positive 4 out of the 7 times. So what I want to show you as well, and sometimes you can find that gold can uptick a little bit early, but look at the trend for gold. So this top graph represents gold, and the bottom graph represents gold versus the S&P 500. You can see here from 2000 and late 2013, you can see here gold was actually underperforming the S&P 500 overall by 30%. But if we take a look here, you can see here gold, it came down into its seasonal period and rallied. Once again, in 2014 came down and had a rally. Then it came down again in 2015, rallied. And again, it rallied in a seasonal period. And so this is really what you're looking at here, is you're looking at these rallies taking place. So it comes down, in this case here, it actually already started to perform well ahead of time before the seasonal period, and that can happen as well. But very often, if you do see a correction coming into the end of the year, that provides a good opportunity in gold itself. And you can see here, gold underperformed in these time periods, but still performed well in its seasonal period underperformed, performed well. And actually, it went past the seasonal period, went down, came down, underperformed, performed well again relative to the S&P 500, performed well again after coming down. You can see here, and we're just looking at the one seasonal period, but you can see here underperformed and then once again outperformed. So a seasonal period that's coming up very shortly is gold. How this fits into the election, really, you want to take a look at what's happening with the interest rates, because if interest rates are rising, that could actually have an impact on gold. But if we start to see interest rates start to fall in December again, because we've gone through that, then I might see a good positive opportunity developing for gold. And the premise of interest rates rising recently was because of the blue wave, extra government spending, pushing interest rates up, and which actually hurt gold. So we've seen gold pull back a bit here, coming into the election, and that could all change. But that's something to monitor as this next seasonal period comes up. Another sector to take a look at is the industrial sector, which has actually performed quite well recently because of the reflation trade and the economy opening up faster than expected as well. Now this is a tough one too, because the economy is opening up faster than expected. But if Biden does become president, he's more likely to lock down the economy as well. So it's a little bit back and forth as far as that goes. But you can see here at this time of the year, you tend to find the industrial sector performing well, and has performed well so far. Actually, because as I said, the expectations for economic increases are happening faster than expected. So from October 28th to December 31st, and also there's a small period in between until the next seasonal period, which is from January 23rd to May 5th. But I want to focus on what's happening with the industrial sector right now. You can see here, this is really usually the time to be invested in the industrial sector at this time of the year. It's produced an average of 5.4%, and being positive 8% of the time from 1990 to 2018, from October 28th until December 31st. And so we're looking at this time period. So if we take a look at the industrial sector, you can see here once again that it's positive seasonal period. Okay, in this case it didn't work, right? And that's going to happen as well. A positive again, a positive again. Now, sometimes you're going to miss a rally that takes place because the industrial sector do well. Outside of that, you're really taking a look, and it's a long-term discipline. It's saying, when you do a bunch of these trades, to say, okay, it's industrials, it's materials, it's financials, and you're stacking the odds in your favor. That's really what it comes down to. In this case, it didn't work because we really started. Remember, we were dealing with trade talks, and that's been in the back burner for so long now. Who knows what can happen there? And it actually worked quite well there as well at the same time. So here we are. We've seen the industrial sector actually perform quite well with relative to the S&P 500. Now, today the reflation trades off. It's very difficult to tell if it's going to come back tomorrow, but overall, this is a bullish pattern for the industrial sector to do well until the end of the year from a seasonal perspective. Canadian banks. Now, the Canadian bank sector tends to perform well at this time of the year, from October 10th until December the 31st, and from January 23rd until April 13th. Now, the Canadian banking sector, in this period here, this is really coming into when they report their earnings, their full year earnings, which is this period right here. And you can see here that the Canadian banks tend to do well in this time period. Now, it goes until December 31st, but I want to put a caveat on that. And so if you see the Canadian bank earnings do well in the summertime, and strong momentum of Canadian bank stocks coming into their next earnings season, so their year end is October 31st, and they tend to report at the end of November, very often they can weaken a little bit as well. So that once again, this trade's going to be driven partially by what's taking place with interest rates and what's happening in the U.S. interest rate market as well at the same time, and the expectations about government spending. So if there's a lot of government spending taking place, or planned to be taking place, or believed to be taking place coming up, that this might actually would drive the interest rates higher, which actually would be more beneficial for the Canadian banking sector. You can see here that you really want to pay attention to the Canadian banking sector in its strong seasonal period. It tends to be a good sector to be in if there's a lot of volatility in the market. So far, that's been the case actually up until now, but it's very difficult to tell what could happen from here. Canadian banks, if we take a look at Canadian banks, Now you can see here that, positive, negative here, slightly negative there, positive, right? Positive again, negative, and in this case, positive as well. So it tends to do well. You can see some drops that take place after the end of its seasonal period. Now this one was a little bit later as well, but this is when it tends to take place as far as the strength for the Canadian banks. So just in summary, overall, in election years, we tend to find that the stock market tends to pull back in September and October. Towards the end of October, it tends to rally later, from late October into the end of the year. Some volatility, but on average, that tends to be up. Next year tends to be a little bit weaker, a little bit softer start compared to the normal years as well, before starting to pick up in March and April a little bit, which doesn't really last that long. And really the big benefit is towards the end of the year. This is an unusual year, of course, and who knows what 2020 can bring us. But it's important to actually take a look at what's happened typically in the past and why those events have taken place. But the overall trend is for the market to be positive at this time, at least coming to the end of the year, and then perhaps settling down a little bit at the beginning of next year. So lots of stuff happening here. And I put the disclaimer here as well for you to read through, and also to the contact information. If there's any questions, I can take some questions on this as well.
All right, excellent presentation, Brooke. Thank you so much. Looks like we have a few questions that rolled in here. A viewer writes in, what are the expectations for the performance of emerging markets after the election?
So emerging markets has a strong seasonal period from late November into mid-April, and that's when it tends to perform well. So it's very similar to the overall 6-month seasonal period for the overall market as well. And for emerging markets, I'd expect that to continue. And the emerging markets can actually do quite well. And the reason being is if we do see big government spending taking place, and that could be either Biden or Trump, you could see some downward pressure on the US dollar, which typically is favorable towards the emerging markets. So given the election, what's happening and the promises for more spending from either party, this could be beneficial for emerging markets, which has a seasonal period start very shortly.
All right, excellent. Thank you so much. Another attendee writes in, what are the expectations for the bond market after the election?
Yeah, so that's a tough one. I mean, because that's partly controlled by the Federal Reserve and also to the government's influence as far as the spending goes. We've got Powell talking tomorrow, of course, and so it'll be interesting to see what he says. But for the bond market overall, the bond market tends to move a little bit sideways here, typically on a seasonal basis. We might see some volatility here in the bond market. But if interest rates are going to go up because of more government spending, then that would actually be a negative for the bond market. So right now, from a seasonal basis, it tends not to be a positive time for government bonds. And also too, if we do have more spending, that actually drive the price of bonds up as well. Or sorry, the interest rates up, which would actually hurt bonds.
All right, thank you so much for that answer. Another viewer here, they're wondering, how will a disputed election play out in the markets?
Yeah, so okay, as far as the disputed election goes, so if we, so it's all about uncertainty. To be honest, it's what's happened in the marketplace last night and even today. So this is the day after the election took place, with now the ballots still being counted. The market rallied based upon, the expected blue wave and more government spending, more stimulus to be coming into the marketplace, and through with the Democratic Party. That was the expectation. And as I said earlier in the presentation, when it looked like Trump was going to win, the market rallied again, just different sectors in the market, and then it's gone swinging back to Biden, and then you see the market rallying again as far as that goes. So that's a very difficult one to say at this point, because you'd expect that if there is some sort of contest in the election taking place to the Supreme Court, and it looks like it might be muddled through, and it might take a while. That's the big thing, I think. If it might take a while, that you would expect to see some volatility in the markets. But so far, that hasn't been the case. The investors haven't demonstrated that. They'd be more than happy to actually get in a little bit early. But typically, you'd expect to see more concern and the market struggle a little bit with things being contested while things are being figured out. But that hasn't happened, so we actually might see the market actually pick up here. It depends on how bad that whole whoever's going to contest who takes place, and what that really means, and if that actually spills out into the streets.
All right, thank you so much. Looks like we might have time here for one more question. Viewer writes in, what about inflation from all the proposed government spending? Are there any seasonal trends that should be monitored?
Yeah, okay, so good question as far as the inflation, seasonality around inflation. Interestingly, we haven't seen any real strong uptick in inflation, and Powell talks about, well, we're going to let inflation run hot and all that sort of stuff. But if we look at it from a seasonal perspective, so government spending will ultimately, at some point, be inflationary if there's too much government spending taking place. It's a matter of when. It hasn't happened yet. It's whether they can overcome the deflationary forces when they go too far. That's really what it comes down to. Right now the velocity of money is actually low. So there might be some room, but it can actually sneak up very, very fast on you. And so from a seasonal perspective, this is where you have to be a little bit careful, because, and I actually have this in my book as well, the break-even inflation rate analysis. And from a seasonal basis, usually the inflation rate expectation starts to pick up at the beginning of the year into March and April as well. So you have to be a little bit careful. So we might see an uptick in inflation expectations coming up, in the new year, which actually might be part of that hampering in the marketplace as well.
All right. Well, Brooke, that puts us right about time. I want to say thank you so much for joining us. Thanks for taking your time out to give us your insights. Fantastic presentation today.
Well, thank you very much for having me on the presentation.
All right. Have a good one.
Okay, thanks.